In this module, we're going to be looking at property portfolio theory. Now, the expression portfolio you'll come across quite often in the property world, but it has a technical meaning specifically related to its relationship to financial investments and a particular system of mathematical analysis known as modern portfolio theory. Now, modern portfolio theory became very popular. In fact, it obtained for a couple of people Nobel Prizes when it first came on the scene a couple of decades ago. And it has particular applications in the finance world, in particular related to investing in equities, in shares in companies. However, you can also apply the same approach to real estate. Now, there's a basic notion in portfolio theory which is very sound. It's almost common knowledge or a common truism. And that is that if you have a certain amount of money to invest, it's better to spread your investment money across a number of investments to get the best balance of risk and return. The idea is that if you have, let's say, $10 million spread as $1 million invested in 10 different investments, if one of those goes down for whatever reason, ends up in a loss situation, at least the other 9 investments will be still pumping along and hopefully support the overall situation, so you won't go bad totally. Whereas if you had all of your money invested in the one investment, then that could be very risky. So the basic notion of diversification is sound. What becomes more interesting is when you try and take that basic truism and apply a lot of mathematics to it to really optimize your portfolio to get the most efficient result. It's important that you read the textbook, particularly Chapter 10. In Chapter 10, you will find the overall dynamics of portfolio theory introduced, and you'll also find a fair bit of mathematics. Now, I'm not at all concerned for you to go into the mathematics. If you really love mathematics and modelling and so on, well, fine, you may find it interesting. But overall, that's only secondary. I would like you to come away understanding the concepts, the reasons for diversification, which I've already basically gone over, and also an understanding of the terms, especially the notion of an efficient frontier. Now, this is an expression that you will find from time to time, especially if you find yourselves working in asset management or funds management. The efficient frontier is a set of different portfolios that all represent good value for money. They aren't necessarily unique. In other words, there may be more than one balance of investments that will give you more or less an efficient or an effective risk and return rate. And so this becomes a surface or the edge of a curve. However, to give you that curve requires a fair bit of mathematics we're not going to go into. I have done it with other classes. It's interesting if you're interested in mathematics and modelling and so on. In this class, we've already done more than our fair share of introductory modelling, hopefully to give you a number of very useful tools to take into your future professional and investment lives. But I'm not going to run you through the mathematics of modern portfolio theory because for a number of reasons I'm going to get to shortly, I don't think it is really mathematical effort that is well spent. And the reason for that is that by the time you go through the basic premises and get to the realities, we find that modern portfolio theory sometimes helps, but it sometimes gives us a false sense of security. I'm just going to look at the basic premises of our portfolio theory. The basic notion of diversification is sound, and it assumes that different investment types operate in different ways, have different markets, have different types of risks, and so their likelihood of failure are going to be independent. If I invest in a property in China, that's going to behave in a particular way. Maybe I'm going to have vacancy at a different time or in different circumstances to if I have an investment in Auckland. especially if in China I'm investing in a factory and in Auckland I'm investing in a retirement village or a residential complex or something. And so the more different the properties are, or the investments in general, the more likely the failure of one is not going to be closely correlated with the failure with the other. And as I say, once we have that assumption, then we can go through with the mathematics. The next thing that is important with modern portfolio theory is to look at the way that risk is quantified. Obviously, if I'm going to be balancing in some mathematical way risk and return, I must be able to quantify those two quantities and in some way compare them. And now we're going to be moving to the realities. And I'll assume that you've already read chapter 10 before you get to this slide. The reality is that the independence of the risks of property is to a certain extent overplayed. It certainly works in the factory in China versus the residential block or the retirement village in Auckland. But more often, portfolios might be between retail and commercial in capital cities, ignoring the fact that often capital cities have very similar characteristics, and also residential and retailing or commercial, while they may have certain areas of independence, on occasions, and these are usually the times when you're likely to lose most money, they tend to move together. And so this failure to acknowledge the linkages in our financial world and the property world is one of the major downsides of practically applying modern portfolio theory. Another major fundamental problem, and you find this all the way through finance theories that attempt to deal with risk and return, is that the measures that are used for risk tend to be highly problematic. And that's because risk of its nature is an unknown. In practice, whether it's the capital asset pricing model or this modern portfolio theory, the measure of risk that we use is the historical variance of the returns. And so if I'm looking at maybe the return on a share, I can look at the prices daily over a long period of time, and so I get an idea of their variance, and I can use that as a measure of risk. The only problem with using variance in return as a measure of risk is that it's not necessarily risk as normally understood. For an investor, for instance, variance on the downside, so in other words, I'm expecting a return of 10%, I only get a return of 2%, I would say that's bad, and I'd be rather unhappy as an investor about that. By comparison, if I'm expecting 10% and I get 18%, I would be rather happy. I wouldn't be at all concerned about uncertainty in the upside. And that upside variance is something which, from the risk analysis point of view, it tends to be considered as just as important or problematic as the downside variance. Now, obviously, there's a problem there, because it means that investors don't like making unexpected profits. Well, that's plainly silly. There are other problems with the measures of risk. There is the assumption that the future is going to be like the past. There's assumptions that the uncertainty of variance will feed into the total value of the investment into the future. And that becomes very complicated and problematic as you look into it. Another independent problem with modern portfolio theory is it ignores significant economic issues. And those economic issues tend to be the linkages, almost external factor linkages, that tend to create in our globalized world a very high level of long-term conformity in the performance of different financial markets, but in particular in the property area. For instance, you may consider that you've diversified by investing some of your property investment money in commercial real estate, and some of it in industrial, and some of it in retail and some of it in residential. And that would appear to be well diversified. However, we have to take a step back and say, well, how safe is that? Does the industrial market really move totally independent to the commercial market or the residential market? Now, if we look at the economy as a bigger issue, we say, well, actually that is a bit of a problem. Because if for some reason, let's say, we have a circumstance of widespread unemployment in the economy, what effects is that going to have? Well, unemployment means that household incomes are going to falter, which means that the residential market is going to falter. So, okay, the residential market is down. But we still have investments in retail and commercial and so on. But those households won't be spending very much money now. What will that do to retailing? So, the next domino falls. Retailing returns. Retailing property is going to look rather shaky. Behind retailing is the whole supply chain. And so your industrial property is going to look rather ordinary, especially if our initial problem is unemployment, because unemployment usually comes as a result of factories and businesses not performing very well, which means that their retailing need and their willingness to pay rent is also faltering. What I'm describing here is a circumstance where these very different parts of the property market, appearing to be coordinated or independent, are in fact operating as though they were closely linked. As our financial world becomes more and more globalized, these kind of interconnections are becoming more and more pronounced, and even across national borders. And this is one of the things that we saw in major economic crises, such as the global financial crisis of the late 2000s. Another economic issue that is lurking behind property in general is the dependence of property investment on the finance markets, on the supply of debt funds. What this means is that changes in interest rates affect all markets in property, as well as the businesses of the tenants for income-producing properties. What this suggests is that property is in fact coordinated through the secondary influence of debt funds. And so these realities mean that we have to be very cautious when we blindly apply portfolio theory with the suggestion that by having a diversified suite of property investments, we're actually going to prevent risk from happening. The reality is that while they may operate in a number of well-behaved circumstances in the economy and the business cycle, when you have serious economic and financial problems, and these are usually global, and then portfolio theory doesn't really help a great deal. In addition to that, there are a number of specific issues with respect to using portfolio theory for property investments. One of the main ones is the very nature of the valuation of property assets. In order to get the kind of data that you need to be able to do modern portfolio theory type analysis, you need regular valuations or regular assessments of the value and the performance of properties. This comes down to meaning, in practice, virtually monthly evaluations of the property assets. Now, this is done by a number of property investment corporations, and they give valuers a lot of work, so perhaps I shouldn't be speaking badly of them. But for those of you with experience in the industry, regardless of where it is, it might be in regional Australia looking at cattle properties, you will know yourself that it's extremely difficult to do meaningful monthly valuations that are going to give you anything like a realistic return or realistic indication of how the property is going. How much does anything from a office tower to a cotton plantation change month to month in terms of its property performance? The answer is most of it is just the noise that comes in from the valuation process itself. And so if you're going to use these monthly variance in returns to work out your efficient frontier for your property investments, you're really developing efficient frontiers that are based on what is simply noise in the valuation procedure. And so what we can see from this is the whole notion of evaluating risk in this way is rather dubious. Now, what this brings us is virtually the full cycle, the full circle in understanding portfolio theory. I'm suggesting that the problem with applying modern portfolio theory, like any of the complex computer modelling methods that you find in property investment and analysis, is that if we become too enamoured, too carried away with the elegance of our mathematical modelling, we can actually draw ourselves unwittingly away from reality. And if nothing else, this is going to expose us to considerably more risk than our clever analysis is going to save us from. Overall, the property economist needs to have a good understanding of the way that the community uses property and the value of property to the community. And these fundamental issues, well behind the normal mantra of supply and demand or whatever, these fundamental relationships is really what is going to distinguish somebody who is going to understand how to see a good investment from a poor one. However, before we can get to that conclusion, it's very, very important that you take my word for it, or simply an opinion, or what have you, or maybe your frustration at the face of complex mathematics. We need to understand modern portfolio theory quite well, and this is why I'm asking you to read chapter 10 carefully, again without being too concerned about the mathematics of it. Read it carefully, understand the dynamics of it, but also be able to critique it with respect to the realities that I'm suggesting that you take some notice of. It's also a good idea, if you have the opportunity, to speak to as many property people, and especially investors and older investors, as you can. I think you'll probably come to the conclusion, and you'll probably find that the wisest of the people you'll speak to will certainly tell you that a portfolio approach to property is wise. However, it's important that you don't let the mathematical cleverness of modern portfolio theory carry away into what could be a fool's paradise.